buried my mother. My sister died in November. It was awful. No thanks. 3, 2, 1.
Good morning and welcome to the Place Your Trades Network. I'm Penny and this is Pax, and this morning we're discussing the pros and cons of volatility. Today's podcast is brought to you by Tradeovate, which has built a custom app dedicated to trading event contracts. This is what we're all using at Place Your Trades. Use the link in the chat to start using the Tradeovate web app for free, where you can follow along and make your own picks. And make sure that you like and subscribe to our channel and set notifications so you never miss a podcast. Pax, happy Friday.
Happy Friday. Happy Capital Preservation Friday. Blaine, that was funny. I had to chuckle when you said the pros and cons of volatility. What are the cons? We're traders. I don't care where the market goes. I just want it to go. I had the other day on Twitter, I had a guy accused me of being one-sided in the market. You know, when I tweet out my levels or my targets, you know, and I'm never one-sided in the market, as you know, because we text almost every morning about the market, and you tell me, what do you think? You know, I think, you know, we've had a major rally this week, and you know, we need to extend above those targets that we've talked about every week since we've been here. We missed last week, but you know, they don't change. They're immutable. 37.26, 39.12, 38.70, 39.12, 40.05, which is going to be important again today. And then 40.99, which was the upside target the other day, with 40.48 to 40.5 in there as well. So those prices have been important on the way up in the S&P, and they're going to be important on the way back down. And then they're important. They give us a frame of reference in this, you know, Michigan's volatility that we've got today. So right now the S&P is trading at 40.25 after the non-farm payroll number came out, and you know, we were trading around 40.75 before the number came out, the SPOOs, and then the market, you know, quickly liquidity dried up and the market was trading, you know, down to 40.07. So these prices are a framework. These targets are a framework to put around the price action in the market, along with my opening range breakout method that I used on the floor that I adapted to the screens. So that gives me the ability to be able to trade real-time price action with real-time information, not lagging indicators, not lagging charts, nothing like that, but using real-time information to make real-time trading decisions, which is then going to help me utilize that framework that I put around the market and to pull money out of the market consistently. These past few weeks have been difficult trading. We haven't had any volatility. We've been stuck in ranges. And when we get volatility, it's off of numbers, you know, CPI, retail sales, unemployment this morning, where it just comes all at once. And maybe later on during the day, or, you know, Powell speaking on Wednesday, you know, maybe after the open in another 20 minutes, 25 minutes, when we open, we get some residual follow-throughs when the algorithms are turned on, the computer programs are turned on for the indices, and the markets start to move again according to that volatility, or according to that volume, you know, the volume that starts to press it. Auction theory for all of the order flow and market profile guys. We are going to have a volatile session today. You know, it's already volatile when the computer programs are turned on on the open and the volume kicks up, and you know, the algorithms are searching for price, you know, price discovery, just as traders are. When all of that happens, I have to be able to make that, like I said, using all that real-time information to make real-time trading decisions. I've got to decide on Capital Preservation Friday if this is a day that I'm looking to be aggressive in, or if this is a day that maybe I'm not. So what I do on a day like this is I'll give myself, and I talk to my traders about this in my group, I'll talk to them about taking the first couple of attempts out of the opening range. The best days for me is when the market, obviously, and it only happens maybe 10, 15% of the time, when the market will explode out of the opening range in the first couple of trades, and then never come back to it. Those are always great. And I'm always looking to add to my positions during those days. I've got a whole formula to work around that, which is going to give me, right? It's going to give me big trading days. If it's not that this morning, if it's back and forth and choppy out of the opening range, then shut it down and wait for the market to become more obvious. So take a trade at one of the action areas in my plan, one of the targets that I use in my plan, or even just a momentum-based trade out of nowhere. I got a DM from a trader in Twitter this morning that thanked me for my tweet about, Anthony's line about great traders are most traders force their trades. Great traders are forced to trade. That's a line I appropriated from Anthony Crudele. And another great line that I've appropriated from Anthony Crudele. But anyway, and he said, thank you, because he immediately took a short in the NASDAQ off the number. And if that market, you do that, take a momentum-based trade. Let's say you sold, I don't know, 11,800. As long as that market stays offered below your entry price, put in a scratch stop and let the market go and stay out of the way of the market. And that's what I'm going to do on the open of the S&P. Let's say, for the sake of discussion, the opening range in the S&P is, let me see where the SPOOs are trading right now. The S&P is trading at 40.14.5. So let's say that the opening range is 40.16 to 40.12. I'm going to get long at 16, and if the market stays bid above my entry price, I'm going to put in a scratch stop, pay for my trade, take profit, let the market go to the target. If it comes back in and it just bangs back and forth all over the place without any real direction, shut it down quickly, take it easy, take my expenses, not losses, take my expenses before they turn into losses, and then come back again Monday, because we are going to have some really, really good trading going into the end of the year. I don't need to force anything today, Blaine. This is good. We are going to have some real good. We got rollover starting next week. And then the second week, or the week of December 12th, we've got CPI, we've got the Fed, we've got other numbers coming out later on in the week. And then we've got for my work and the way that I do my technical work, we've got the most important number of the entire quarter, which is expiration, coming out Friday after the close. We'll have expiration price. That is going to be so very important. And then going into the end of the year, we've got the end of the year, we've got the end of the month, we've got the end of the quarter, all rolled into one after expiration. The month of December is historically some of my best trading months, and at least on the screens. Wasn't on the floor, but it is on the screens. So I'm looking to take advantage of that price action. It doesn't need to be today. All that to say, Capital Preservation Friday reigns again, period. God, lots of talking again. I do that all the time.
Pax, I have a very specific question. Yesterday, I trade SPY options based off the S&P. That's it, the way I trade. And yesterday, I was long above the opening range. And in about a 30-second period, SPY shot up and top ticked 410, which I know is a very important level in the SPY, and then immediately came back down. I took it was so fast, I didn't even have a stop in. So it sort of wrecked that trade, went below the opening range, and then kept dumping. And it was so fast. And I've always wondered, what is that? Is it just taking out all the orders above and then taking out all the stops? Or how does that happen so quickly that it'll break through, reject, and then dump? It's happened to me a couple of times.
I don't really look at, I quit trying to figure out the why of things a long time ago. Are they running stops? Are they, because it's computer programs that are doing this. It's computer programs that generate the vast majority of the volume, and it's computer programs that are going to move the market all over the place. So these algorithms are reacting to price. The algorithms are reacting to news. The algorithms are reacting to things that we don't even know about, and they're out there searching all of this. So it could have just been something as simple as somebody coming in and buying a gigantic block of S&P with a 4110 limit. That market came back down. It ran up to 4110 in the S&P and then came back down to 40.99, and underneath 40.99 it took out the bottom of the opening range in the 40.80 area. I forget what the opening range was, but when it did that, then the very first thing that I do when I initiate a trade I don't know why I can't remember what the opening range. Oh, hold on, I'll look it up. But when I initiate a trade, the first thing I'm going to do is I'm going to put in a stop, so that in that event I'm going to be protected in whatever the algorithms are going to do to the market. Opening range bottom of the opening range was 89.75, 40.97 half to 40.89.75. So, I'm long. I was actually long in that. So I got long at 98. I paid for that trade at 01.75. No, whatever the 4 points is, 01.75. Paid for that trade. I did not. I got my stop in before I was able to take profit up at 41.09. Or where I was going to take profit. So I just ended up. I paid for that trade and scratched out the rest of it. That's the most important part. And then when we get back in, I don't care how fast it goes or how slow it goes, because the thing that matters most to me is price, not time and not volume, just price. So the fact that we got above the opening range, I put in a scratch stop, I paid for my trade, market ran up to 10 and then came running back down. That was a very, very quick, very, very fast algorithmic trade. And it's just not something I really want to be a part of. We got short underneath 89.75 and paid for those and took them down to I forget what the low was, like 62-ish, and then came back up. Yesterday was it was a very, very nothing trading day. And a nothing trading day, I want to shut it down. I'm there, I spend the time in front of the screens like everybody else. I'm there. Wednesday, when Powell was speaking, I was not in front of the screens. I was at the eye doctor. But there were a lot of traders in my group that were able to get long above 40.05. We were trading, if you remember, during Powell's speech, we were trading in like 39.80 all day long, back and forth. And they went down, during his speech, we went down into the 39.60 area. And then he started yapping, and that market just started. I was already gone, but they were putting framework around the market, right? Like I said earlier, taking the action areas of my plan or the opening range or whatever we all use, whatever frame that we all use. We all need to have some sort of reference, some sort of framework to put into the market for reference. So traders in my group were all able to get long above 40.05, take them up to the 200-day moving average at 40.5, and then take them up to 40.99. It was a great day for many. And I came back. Oh, that's another thing I wanted to talk about. I came back with nothing on, and I felt frustrated yesterday. I felt frustrated because I didn't catch any of that. I felt frustrated because the last 3 weeks have been difficult trades. There hasn't been much volatility, many breakouts. I'm a breakout trader, none of that stuff. So when we finally got it, I'm at the eye doctor, but I've got a serious eye condition that causes blindness. So I actually have to go to the eye doctor. I couldn't blow it off. And I found myself trying to force some trades yesterday. Because I missed Wednesday, I found myself over trading a little bit to the short side yesterday. Then I found myself getting a little opinionated. Wait, we're below the opening range. We're going to trade back down to the 200-day. We can take out the 200-day and we can retrace back down to 40.05. And I shut it down, and I've had a cold for the last week or so since Thanksgiving. So I went and worked out for the first time in a week or so. I had to get out from my screens. I had to go do something other than staring at the price action, because I knew that today is going to be another day. And even better than that, towards the end of the year, the last 2.5, 3 weeks of the year are going to be really, really, really good trading.
Pax, Anthony asked if you could talk about why we see highs and lows made on rollover weeks.
Oh, I hate rollover. So, rollover is what time is it? Okay, we got time. Rollover is, for those of you guys unfamiliar, with futures and the way that futures work. Open interest is the amount of open positions in any futures contract. And open interest is what determines volatility. And the CME publishes the open interest net number and also the net change every day. So if open interest grew in crude, or S&P or whatever, that's because there was more buying coming into the market. If open interest declined, it's because there was more selling. So anyway, open interest is the amount of open positions. Futures contracts run the world. It's for, at least in the trading world. Futures markets are for 100 different reasons, are the most important instruments to pay attention to and the most important instruments to trade. One of the main reasons is because Leo Melamed, the man who, the father of futures trading that brought this into what we do, has had the foresight and the wisdom to make sure that the futures contracts were tied to something real. And that was going to be at the end of the quarter is when expiration was going to happen in the financial futures, so that that ensured that the open interest, without getting too far into the weeds, open interest has to roll every quarter. So, we start, actually, my wife came down on Monday to remind me, because my wife was a trader not a trader, but a clerk for 18 years on the floor. She came down and she whispered to me, remember, rollover starts today, because she knows I hate rollover. It started Monday. It picks up next week, where open interest rolls from the December contract into the March contract. Open interest is going to pick up more. The roll of open interest is going to pick up more on Monday, and then it's going to culminate more towards the end of the week next week. So next week, I am not going to trade very much. I am not going to be active. I will only take easy trades. I'll sell 16s, and if the market stays 16 offer, I'll manage it. That's it. I won't do it more than twice, period, because going into expiration with all of that other stuff that we mentioned earlier is when we're going to have that exacerbated volatility. Now, when open interest is rolling, it has a way, and this is why I love trading the fourth quarter roll. When open interest is rolling, it has a way of exacerbating, without getting too far into the weeds again, it has a way of exacerbating the volatility. So if we're rolling, if we're rolling higher, if we're rallying or we're breaking, with the rollover, it's going to push the market, could push the S&P another 10, 15, 20 handles, and then it's going to stop on a dime and reverse. So where technicians are going to start thinking that that's a major, breakout, or that's a major reversal, ultimately it's just the market reacting to the roll of open interest. So again, using a framework, putting that framework around the market and making sure that we are consistently, we are consistent, we're scalable, and we're repeatable in our process and our methodology. Putting that framework around the market during rollover is going to help us identify those highs and those lows that are more a form and function of rolling open interest, rolling volume, than it is in any sort of technical breakout or anything like that. I don't know if that makes any sense. I don't know if it's helpful. Hopefully, Anthony, that's what you wanted me to kind of answer in a 2 or 3 minute long period. I don't normally like trading the roll because it exacerbates volatility. The market stops in strange spots. I might have a major target at 40.05 is a major target for me. We might, and it's always 2 points. So 05 to 07, or an upside target of 40.48 to 50, the upside target of 40.99 to 41.01. I'm always looking for those 2 point targets, right? So, if during rollover, market is weak and it's breaking and it's going crazy, and I've got a major target at 40.0507, but it stops at 40.11 and then rallies 80 points out of nowhere for no reason. There's nothing going on. Well, it's rollover. That's the kind of stuff that goes on. I don't know if that answered it really quickly, but it's very, very, very important to understand what rollover is and how it affects the trading. It'll exacerbate the volatility going into the end of the year, culminating in expiration on December 16th.
Pax, this morning, Canny said in our chat, Tom Canfield said that this market is very emotional. And it truly is as emotional as like a preteen girl. It is really, it is, or at least me as a preteen.
Or my daughters have got three of them.
It's so emotional. So this morning we had some job numbers, and it came out that Americans have jobs. Market drops. I'm feeling bullish just we made a big move up. We didn't make that big of a move down yesterday. It was a tiny little move. And just in general, I feel very bullish going into December. This looks like a massive red candle off of that news, but we did need to go back and retrace a little bit because the move up was so quick. Is that correct?
Well, it can be. And okay, now, you know, I make a big deal out of, you know, yelling on Twitter. I don't fade markets. I don't fade markets. And I don't fade markets. We had a major breakout to the downside today. We had a major breakout. Well, no, we didn't. We're trading within this a really big range today. That's it. We had a major breakout on Wednesday to the upside. Now, I'm bullish too, but not because of you know, I'm not a macro analyst, and I have not dug in. I will dig into the number and what it was about and all of that. And I'll talk to Ira Harris, who's me and another one of me and Anthony's shared mentors, about what that number truly means macroly. But I'm bullish because we're above 39.12 and because we're above 40.05. I'm bullish because 40.05 to 07 was tested this morning off that number and it held. But that doesn't mean, Blaine, that, you know, if the opening range we're trading at 40 quarter, right, or 40.26, that doesn't mean that if the opening range is set here, that if we break to the downside, I'll be short, you know, even though in my mind and in my sentiment, I think that we are going higher going into the end of the year. I do believe that as well. I don't know. I mean, that's my opinion. That's my bias. I try not to trade my bias. I found myself starting to trade my bias yesterday. And so I decided that I was going to shut it down and go work out. I've got to trade the price action as it is, not as I want it to be. And I've got to use my frame of reference to be able to take real-time trading decisions, real-time trades, using real-time trading decisions, using real-time information, not with the benefit of hindsight. So again, I'm bullish in thesis, and I have been since September. When September expired at 38.71, I had a small group of the traders that I mentor, and I told them all that December is going to expire higher than September. Now, I mean, everybody and their brother were bearish. We're going lower. We're going to the 33 handle. And I tweeted this out. I said, maybe we very well might. But the way that I do my work is telling me that we are going to settle higher than 38.71, that we are going to rally, and we are. Now, you know, I mean, I'm not that smart, so this is not me making a call. This is my work and me staying true to my work that makes me look a lot smarter than what I really am. Now, and that's the case. So without trading my bias, I'm going to trade my process. If we rally, now, if we rally out of the opening range, I will be more aggressive. I'll be buying them more aggressively, especially going up to 48.5. Above 48.5, I'll add.
So it is 9:23. Do we have just 2 or 3 minutes to make some picks?
Sure. Let's do it.
So
okay.
we're looking
What do you
at
think?
the S&P here. I mean, I'm feeling a yes today.
Okay.
But I mean, that is just based on vibes. You know, I love to trade on vibes. Have you
practiced the left trading on vibe? Maybe that, you know what? Maybe that's why your Tradevate account, your event contract isn't going so well. You're trading on your vibes. What about this straddle? Have you practiced putting on Anne-Marie's straddle a yes and a no to balance themselves out and then trading out of one or the other later?
No, but I sure do need to.
That's hilarious.
I'm growing up slowly. You know what I mean? It's like I'm graduating elementary school right now.
Well, all right. I think we're going higher too. I would like to see the 40 halves a little bit cheaper, but I wouldn't mind taking those 40 halves. And if we see 40, if we close above 40.50, I think, well, 40.75 is a little bit further away. But I think I think the market attacks the 200-day moving average, and I think we close above it. So I like the 40 half yeses. especially since you're feeling it. I'm cooler than you. I like saying that. I like that name. I'm cooler than you also likes him too. So he's cooler than me. So I think that's cool.
You're very cool, Pax.
Well,
Do you want
I
to look at the snazzy Nazi?
Another thing about the NASDAQ is the NASDAQ has been weaker, obviously a lot weaker than the S&P all year long. The best rallies that we've had, the rallies that sustain, in the indices are when the NASDAQ also has some strong price action. The NASDAQ was lagging in this particular rally. Last week, the high of the NASDAQ was this is the overnight session, the all sessions, what I call it, had a high of 12,120 or 12,118, while the pit or the day session had a high of like 12,065 ish. So that was lagging. That was last week. Yesterday, it was lagging while the S&P, or Wednesday, while the S&P was screaming higher. I had the NASDAQ rally too, but the NASDAQ was following the S&P. I would have liked to have seen the NASDAQ get above and stay above 12,100 yesterday. It was lagging. So, I'm actually, I'll go back, put those strikes back up. Let me see what the strike prices were. 11,000. Yeah, take the yes on 12,000. You for sure take the yes on 12,000. That's cheap. That's good.
I think I'm gonna do 10.
Yeah, I wouldn't. I would. Those are cheap. I like that.
That's a big trade. The payout's $165.
And it's cheap. And it's only 150 points away. The NASDAQ has been lagging, and it's been lagging or weaker, however you want to look at it. If you're bullish, the NASDAQ has been lagging. If you're bearish, the NASDAQ has been leading. Now, if we find a bid, if the S&P matchups, I always talk about matchups. If the S&P gets above 40, 50, that 200-day, 40, 48 to 50, the NASDAQ should definitely get back to that area. So I think it's a good trade. Gold.
All right.
Gold?
Well, we only have 3 minutes left. You want to look at gold or
crude?
Oh, whoops.
I've been dialed in with crude lately.
Nice.
Yeah. I like the way you say that. Nice. All right, where are we at in crude?
81.
Okay. Go scroll down. Let's see what the no's are. Shite. All of a sudden my brain isn't going. Take the nose on $80. That's $3.75. If crude is at a major inflection point, so 81.5 to $81 and 81.50, 81.60 is a pretty big area for crude. If crude gets above it, it'll go back up to 83.30. If crude gets below it and stays below it, we should get back down to like 79.50, 79.60, that area. Underneath 79.50, 79.60, then it's another $2 lower. So crude has been a really, really good trade lately.
All right, Pax, the market's about to open. I appreciate you. This is my favorite time of the week.
Me too. Happy Capital Preservation Friday. Have a blessed weekend and a profitable day, everybody.